Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Carvana is an online used car marketplace headquartered in Tempe, Arizona. It lets consumers buy, sell, and finance vehicles entirely through a digital platform. No dealership visit required.
The company was founded in 2012 by Ernie Garcia III, whose family also controls Drive Time, a traditional used car lender. Carvana went public in 2017 at roughly $7 per share.
What makes Carvana different is vertical integration. It reconditions vehicles in its own facilities, finances buyers through its captive lender, and delivers cars directly to customers' driveways.
Those iconic multi-story vending machine towers? They're more than marketing. They serve as hyperlocal delivery hubs and reinforce the brand's promise of a frictionless buying experience.
Revenue breaks into three buckets. Used vehicle sales generate roughly $10 billion annually. Wholesale vehicle sales add about $2.5 billion. Finance and insurance contributes the rest.
The key unit economics metric is gross profit per unit, or GPU. Carvana now generates over $6,000 per vehicle sold, a dramatic improvement from near zero during the crisis years.
That crisis was real. Pandemic-era used car demand created a buying frenzy. Carvana overexpanded, took on billions in debt, and by late 2022, the stock had fallen more than 90% from its peak.
The company restructured its debt in 2023 and integrated the ADESA auction network it had acquired. Those physical logistics hubs gave Carvana the throughput capacity its reconditioning model required.
By 2024, Carvana had returned to profitability, rejoined the S&P 500, and demonstrated that the underlying business model, when properly capitalized, can generate attractive unit economics.
On the competitive front, CarMax is the largest traditional used car retailer with a nationwide physical footprint. AutoNation and Lithia Motors also compete, but primarily through franchise dealerships.
Carvana's edge is digital-first convenience paired with inspection transparency. Every vehicle comes with detailed photos and a documented condition report, reducing the anxiety of buying a car sight unseen.
The balance sheet remains a watch item. The debt restructuring extended maturities, but interest expense still consumes a meaningful share of operating cash flow. Deleveraging is a multi-year process.
Ernie Garcia III remains CEO and controlling shareholder. His long-term vision centers on capturing a larger share of the 40 million unit annual used car market, which remains highly fragmented.
Carvana operates in more than 300 markets across the United States. Its reconditioning centers and logistics network continue to expand as vehicle throughput grows.
The story here is a turnaround with structural underpinnings. Digital used car retail is still early, the unit economics have improved dramatically, and the competitive moat is being rebuilt from the inside out.
Whether the debt burden remains manageable as growth continues is the central question investors need to answer before forming a view on this name.
That's the company chapter for Carvana. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers? Let's go.
Carvana just delivered a quarter that silenced the doubters. Q1 2026, revenue up 52% year over year to $6.43 billion. EPS of $1.69 versus the street's $1.50 estimate, a 12.7% beat. Retail units up 40%. The sixth straight 40-plus growth quarter. Wall Street responded with a wave of price target hikes. This is Charged Alpha. Let's break it down.
Carvana is the largest online used car retailer in America, market cap of $70.9 billion. The model is simple. Customers shop, finance, and buy used cars entirely online, and Carvana delivers the vehicle to their door or to one of the iconic glass car vending machines. The moat is vertical integration. Carvana owns the inspection centers, the logistics network, the financing platform, and the inventory.
What makes the story remarkable is the comeback. Carvana flirted with bankruptcy in 2022 when interest rates spiked and used car prices crashed. Management restructured the debt, slashed costs, and rebuilt the unit economics. Q1 2026 is the proof point. record GAAP operating income of $581 million, and record adjusted EBITDA of $672 million.
Let's walk the income statement. Total revenue was $6.43 billion for the quarter, up 52% from $4.23 billion in Q1 2025. Retail units sold hit a record 187,000 vehicles, a 40% year-over-year jump. Net income came in at $405 million. EPS of $1.69 beat the consensus of $1.50 by 12.7%.
On margins, gross margin was 20.2%, solid for a used car retailer. GAAP operating income hit $581 million for an operating margin of 9%, in line with the prior year. Adjusted EBITDA was a record $672 million. The adjusted EBITDA margin dipped slightly to 10.4% from 11.5%, primarily from a revenue recognition change rather than fundamental margin compression.
One number that bears watching: non-GAAP gross profit per unit, or GPU. That figure declined to $6,911 from $7,140 in the prior year, a 3.2% decrease. Retail revenue per unit climbed, but retail cost per unit climbed faster. Management is choosing volume over per unit margin, which is the right strategy if scale economics keep flowing through.
Cash flow and balance sheet. Trailing 12-month operating cash flow is $430 million, and free cash flow is $889 million. Cash on the balance sheet is roughly $2.4 billion against total debt of $5 billion. That's a net debt position of about $2.6 billion, meaningful but manageable given the EBITDA run rate.
Total assets stand at $13.8 billion. Equity is roughly $4.2 billion. The capital structure is still leveraged compared to traditional retailers, but the trend is improving every quarter. Management has been opportunistically refinancing debt at lower rates as the credit profile strengthens with each beat and raise quarter.
Bottom line on the numbers, this was a clean operational beat. Revenue, EPS, units, and EBITDA all set records. The only soft spot is GPU compression, and even that reflects deliberate volume strategy. Management guided Q2 to set new records in both retail units and adjusted EBITDA, assuming the macro environment holds steady.
Analyst sentiment is overwhelmingly bullish. The consensus breakdown is 19 buy ratings, 3 holds, and 0 sell ratings. The average price target sits at $475. With the stock around $327 heading into the print, that target implies roughly 45% upside. After the beat, at least 7 firms hiked price targets, with bullish revisions clustered between $465 and $600.
The valuation math, Carvana trades at roughly 47 times trailing earnings and 32 times forward estimates. Price to sales is about 3.5 times, and EV to EBITDA sits around 28 times. Price to book is 16.9. By any traditional retailer metric, this is expensive, but bulls argue Carvana is a tech-enabled platform compounder, not a dealership.
Needham led the bull pack at $600, citing strong operational momentum and the 40+% vehicle sales growth streak. Barclays raised its target from $430 to $475, maintaining overweight. Morgan Stanley called it a clean beat with momentum building into fiscal 2026.
The cautious voices are smaller but worth hearing. Bank of America downgraded to neutral on April 6th, citing rising rate concerns and intensifying competition from KMX and traditional dealer groups. UBS called the quarter solid with EBITDA roughly 4% above consensus, but flagged that GPU compression could continue if mix shifts toward lower-priced vehicles.
Beta is 3.61, extreme. That means Carvana moves roughly 3.5 times the broader market on any given day. Forward EPS for 2026 is pegged at $10.13, with full-year revenue projected near $32.9 billion. Hitting those numbers means the stock looks reasonable on next year earnings. Missing them means the multiple compresses fast.
The bull case rests on 3 pillars. First, scale economics. Each additional retail unit flows through a largely fixed reconditioning and logistics network, so incremental margin should expand meaningfully as volume scales toward the 3 million unit long-term target.
Second, the ADESA acquisition. Carvana now owns dozens of physical reconditioning megasites across the country, dramatically increasing capacity without the capex of building from scratch. Those facilities are still ramping, which means the operating leverage story has years left to play out.
Third, market share runway. The U.S. used car market is roughly 40 million units annually and remains massively fragmented. Carvana's 187,000 quarterly units is under 2% share. Even modest share gains compound into enormous revenue growth at the current scale.
The bear case starts with the balance sheet. $5 billion in total debt against $4.2 billion in equity is a leveraged structure for a cyclical business. If the used car cycle turns and EBITDA contracts, debt service quickly becomes the dominant constraint on the equity story.
Beta of 3.6 is the second concern. This stock can drop 30% in a week on macro headlines that have nothing to do with Carvana fundamentals. For investors who size positions based on volatility, Carvana demands a smaller allocation than a typical equity holding.
Third, GPU compression. Gross profit per unit fell from $71.40 to $69.11 year over year. Management frames it as deliberate volume strategy, but if the trend continues, the bull case for margin expansion at scale becomes much harder to defend.
Fourth, valuation. The stock trades 14% above the $475 consensus price target. At 47 times earnings on a cyclical retailer, any disappointment in unit growth or rate environment could trigger a sharp multiple compression. Stocks priced for perfection rarely tolerate even minor stumbles.
Carvana's natural peer group includes KMX, which is CarMax, AN, which is AutoNation, ABG, LAD, which is Lithia Motors, and the legacy franchise dealer groups. Among those, KMX is the closest direct competitor, used car focused, scaled, and publicly traded with comparable disclosure.
Versus KMX, Carvana trades at roughly twice the revenue multiple. KMX sits around 1.5 times sales, while Carvana is at 3.5. The premium reflects Carvana's higher growth rate. KMX is growing in single digits, while Carvana is compounding at 40% on units and 50% on revenue.
Versus AutoNation and the franchise groups, Carvana looks even more expensive on PE. Those operators trade in the 8 to 12 times earnings range, reflecting mature growth and physical store overhead. Carvana's online-first model carries higher fixed costs early, but better unit economics at scale, which is exactly the operating leverage thesis.
The differentiator across the peer group is digital infrastructure. Carvana invested years into the website, financing platform, and delivery network when no competitor was doing it at scale. Now, when used car shoppers want a frictionless online experience, Carvana is the default choice. That brand and platform moat is the single biggest reason for the premium multiple.
Options activity around the print was bullish. Implied volatility was elevated heading in, pricing roughly an 8% move. Call volume on the 400 and 450 strikes was unusually heavy, signaling traders were positioned for an upside surprise. After the beat, IV crushed quickly as expected.
Interestingly, the stock dipped about 3.4% post-earnings, despite the clean beat, a sell-the-news reaction after a 36% rally into the quarter. Traders who sold premium ahead of the report captured the volatility crush even as the directional move went against them.
On insider activity, the picture is mixed. CFO Mark Jenkins exercised and sold 12,750 shares on April 1st under a pre-scheduled 10b5-1 plan. The pattern across the executive team has skewed towards selling, which is normal for a stock that has rallied this hard, but worth noting for investors looking for insider conviction signals.
Institutional ownership is robust, with major index funds and growth-focused managers as the largest holders. The float is relatively concentrated, which contributes to the high beta. Large institutional rebalances can move the stock disproportionately. Short interest remains elevated, a leftover from the 2022 bankruptcy fears that hasn't fully unwound even after the operational comeback.
Bottom line on Carvana, a record-breaking quarter, a 40% unit growth streak, and a wave of price target hikes. The fundamental case is firing. The risk is the premium price tag and used car cycle exposure.
If you own it, the operational story justifies holding through the volatility. Long-term unit and EBITDA targets are credible. New buyers should size carefully, given the 3.6 beta. Charged Alpha rates this high conviction growth with elevated risk, outstanding execution, demanding multiple.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.